Welcome to this Friday webinar. Today we have Mr. Anup Maheshwari, who needs no introduction. We know him quite well. I'll still, try and introduce him. He brings with him 24 years of experience, has been working with 361 Asset Management, and he's heading 361 as a co-founder and CIO. Before that, he has worked with DSP as well as Merrill Lynch and HSBC. Welcome to this Friday webinar, Anup. We have done webinar in the past also on our platform. At PMS AIF World, every Friday in the evening, we do webinar with one of the other fund managers to understand what's going around. And we know recently there has been a rate cut of 50 basis points, and market is kind of now seeing renewed, I would say, optimism. Though seeing all the ratios as of now, many investors have been kind of cognizant of the high risk in terms of valuations. But yes, liquidity is ultimately something which is supreme. But these are I would say broad thoughts that we have in our mind and understanding of markets. But we know long-term undertone of equities in India is like bullish because the growth, is ongoing, and there are no other uncertainties. We know there are many uncertainties around the world in terms of if we compare ourselves to any other larger economy, be it China or US or UK or Japan. So hence, obviously, world inflow in terms of FI money has to come to India. But we want to understand from you what is the near-term way forward, maybe next 1, 2, 3 years from here onwards, and how are you seeing equity markets at this juncture? And that's the broad topic that we have kept at markets and way forward from here onwards.
Sure, Kamal. No, great to come on board again on the platform. I think it's always very informative for me as well in terms of the interactions and the questions we get. You've already answered half of my questions, the stuff I was going to cover in your introduction itself, but I'll take you through a few slides. I've just got 4 or 5 slides to run through, just about context, both medium-term context, the opportunity in India, and then also just to put in perspective, valuations like you mentioned at the start, just to give some color on that as well. And then, of course, we're very happy to then make it more interactive in Q&A form. So let me just first of all start the presentation. So very quickly, if normally if I had to present India in one slide to any investor in locally or globally, this is pretty much the slide I would put up, which is at the end of the day, for all the positive macro and where we're going as an economy, as a country, I think finally people have to make money by investing in the market. And India is one of the few markets in the world where it is very aligned with that underlying growth. And if investing is all about compounding money at attractive rates over long periods, that's what all investors across the world try to do. We wanted to actually test that hypothesis with a very simple analysis of how many companies in the world have been able to create shareholder wealth or compound shareholder wealth at 20% or more in dollar terms over a 20-year time frame. That's serious compounding over a long period of time. So we started by looking at 4 largest economies of the top 5. So we looked at, on the left-hand side, you'll see we looked at India, we looked at the US, China, and Japan. And then we looked at the top 500 companies in each of these markets. So if you look at India, it's the BSE 500. In the US, it's S&P 500. In China, we've used MSCI China. And in Japan, the TOPIX 500 index. Now look at the number of compounders that have emerged from each of these 4 economies. India has had 111 out of 500 companies deliver 20% dollar compounding to shareholders over 20 years. The US in the S&P 500 is just 17, China is 13, and Japan is 0. Effectively, India has more compounders than any other economy, a whole bunch of them put together. And I think that has really been the strong point of India, which is the micro part of India, the ability of companies to deliver, understand, first of all, return on capital, capital allocation, deliver scale, and through all of that and profitability, create shareholder value. And on the right hand side, we said, listen, maybe 20 years could be a base effect. Let's take a 10-year period. but it's pretty much the same picture. India has the highest number of compounders, 20% and 25% dollar compounders over a period of time. So this is the bottom line. I think this is why people need to take a long-term view, because there will always be some businesses or the other that have the ability to scale and create sustainable wealth for investors. Just to give you an example of the scale, we thought we'll go through one specific example just so that it's not just talk, but we can show you one sector, for instance, and it's a very well-known sector that can potentially scale. And what sort of scalability is there? So I'm just picking up on financial services because that's clearly India's largest sector in the stock market, almost a third of the stock market. And within financial services, particularly banks, a large part of bank balance sheets now is in the form of consumer lending. So we thought we'd just talk you through this to give you an idea of the scale potential. So on the left-hand side, you'll see, the India's GDP is about $3.7 trillion today. And overall lending in India by the entire system, all banks, finance institutions put together, is about 1.9 trillion. That $1.9 trillion is basically two forms of borrowers, corporates and retail. Retail is individuals. So 35% of this is retail, which amounts to about $650 billion. So if I look at the total credit at a household level in India, it's $650 billion on a GDP of 3.7 trillion, which works out to roughly 20% is India's retail credit to GDP ratio, as we call it. Now, it's an interesting ratio because if you compare it across the world, you'll see that most economies, most emerging market economies, are between 30 to 50% of retail credit to GDP. If you look at developed economies, they're anywhere between 50 to 100% of retail credit to GDP. So India is still at the lower end of that entire curve, and clearly we have a long way to grow. Now, where is that growth going to come from? So on the right-hand side, we've given, we've sort of looked at the big picture on top. You'll see we have roughly 330 million homes, about 4 to 5 people in every house. Per capita income is about $2,600. Now, of course, we know that income distribution in India is not very linear. So typically India is broken, and we've broken it up into 3 Indias, India 1, 2, and 3, based on income levels. So India 1 is the top 10% of households. So that's 33 million homes who have a per person income above $3,700 per person. Of course, while our overall per capita in absolute terms sounds very low at 2,600, purchasing power parity is much higher. That's about 3.5 times this number. So India 1 has $3,700 and above, and this goes all the way up to the billionaires of India. And interestingly, of this credit number, retail credit, about 70% of that goes to India 1. So the top 10% homes account for 70% of total credit already. And in fact, in our hypothesis, the top 10% homes probably make up close to 2/3 of all consumption in the economy. Because if you think about it, 33 million homes, roughly number of people in these homes multiplied by 4, we're talking of, let's say, 120 odd million. And then when you correlate that with, anecdotal indications of consumption capability, for instance, today, how many passports are there? How many Indians have a passport? About 100 million. How many mutual funds accounts are there? It's about 125 million demats. How many people pay taxes? About 70 million. How many credit cards around? About 85 million. So it's this 120 million that really is the dominant part of India. This population, India 1, that is driving most of the consumption as well as the credit growth historically. And they will continue to grow. But what is interesting is how India 2 and India 3 are beginning to emerge and add to that. So India 2 are the next 20% homes, 66 million of them, with per capita income between $1,750 to $3,700. And this is the part of the pyramid that is actually growing quite strongly. It's growing the fastest. So just mathematically, if India too continues to grow, in another 7 to 8 years, India too will start getting into a lot of India too will migrate effectively to the India one of today. So which means that a lot of India too will show rising consumption, rising borrowing, rising sort of spending. And this is a big number because 66 million homes effectively implies close to 250 million consumers. And there's very few places in the world, if any, where so many consumers will get added into the system with rising consumption capability. So clearly, India too will be another very important source of incremental borrowing and credit. And then, of course, there's India 3, 70% of the population, which is up to $101,750 per person. This is the poor part of India. Only 10% of formal credit goes to this 70% of the population. And we often discuss this, that after so many years of independence, we still have 70% of this population at such a poor per capita, which obviously is a key factor for overall India per capita to be where it is. And the big question is, when does India 3 start growing? And to our minds, the biggest reason for such a large base to have been stuck in this zone for so many years is simply because they were till, I would say, 8-10 years ago, most of India 3 was not part of the formal financial system in the first place. Most of them didn't even have a bank account. So thanks to the whole UPI Aadhaar program, now 500 million bank accounts have opened up in the last 10 years. Most of that is India 3. So these are first time part of the financial ecosystem, households. And somewhere down the road, once you come into the formal financial system, I think it's your first chance at growing economically, in the sense that I'm sure there are millions of enterprising Indians in India 3 who want to come up economically, but are constrained because they have to borrow from informal markets at incredibly high rates of interest. Now, with formal credit potentially available to them, thanks to this opening of bank accounts, I think it'll be a very interesting trend in India 3. So micro loans, gold loans, microfinance, all heading towards India 3 potentially at much lower rates, will clearly catalyze India 3 as well. And for the first time, we can see potential for India 3 to actually emerge economically in a much stronger fashion over the course of the next 2 decades. It'll take time, of course, given the base and current income levels, but I think at least we now have a platform for them to be able to come up. So when we add all these 3 together, India 1, 2, 3, we can easily grow credit at 15% per annum for the next 10 years. And we would still be fairly at the lower end of retail credit to GDP, or very modest level of retail credit to GDP, and nowhere near overexposed in that sense. So this is just an example of potential value creation, compounding scale that still exists, let's say, in one of the biggest sectors in India. There are many such stories that can be told. The challenge, though, is the valuations, as you rightly mentioned at the start. So there's no doubt to our mind that India is a fantastic long-term story. I don't think any of us have a doubt about it in terms of growth, in terms of the leadership, in terms of the economic, reform trends, etc. So I think that is pretty much in place. The challenge, of course, for a lot of us has been valuations, and a lot of valuations obviously getting pushed by the flow of money, as you mentioned. But I will correct one thing that you said at the start, Kamal, which is flows are not supreme. It's valuations eventually that are supreme. And flows can create distortions in the short run. Valuations are really what reality is. Now, this is, the background to this slide. This is the Sensex price to book ratio, as you can see the chart on top, over the last 24 years. And the background to this was that, we believe price to book is a very good indicator of points at which markets can go through correction phases. We wanted to look back into the past at large corrections. We keep saying Warren Buffett's first rule of investing is don't lose huge amounts of money. So we try to define that as a 30% or more fall We wanted to see how many times does India experience that. And in the last 40 years, there have been 7 instances when India has fallen 30% or more. And then we wanted to look back as to what were the valuations before the fall. And P multiples don't give you an idea because earnings themselves change. But price to book is a very stable measure because it's a multiple of your market cap to net worth, and net worth doesn't change as much. So in all those cases, what we realized was the price to book had crossed a certain threshold, and that's when the market starts getting tricky. So this tends to happen, and we've given the statistics below in the chart. You'll notice that obviously for the most part of time, the market trades between 2 and 4 times price to book. Time wise, 86% of the time the market is in this range. This is in the range of fair value, with returns over the next 5 years of 11 to 13%, which is normally what we say equity should deliver 13 to 15% maybe. But whenever the markets go beyond 4 times or below 2 times, those start becoming more extreme behaviors. Less than 2 times, of course, is fantastic. It doesn't happen that often, but whenever it happens, you should be investing everything. Of course, fear is the highest at those points, but that's when the opportunity and the returns are also potentially the highest. You'll see the market doesn't spend too much time there. 5-year returns, CAGR, tend to be 40% annualized, which is exceptional. But where we're sitting today is above 4 times price to book, where the 5-year outcome is not great. It's 4%. It doesn't spend too much time in that zone, and this is where you're vulnerable also to some corrections. So we're in a zone now, therefore, where how do we marry this very positive long-term outlook with the markets and the valuations that we see versus the flows? That's all mixing things up a little bit. Our view is that we need some degree of consolidation in the markets. We're seeing a lot of rotation happening. Thankfully, the index seems to be broadly consolidating. Maybe it needs to consolidate for a fair period of time, or maybe some small corrections, so that the ratio, the price to book, comes off. With every passing year, in any case, the price to book will fall by 10 to 12%, the ratio, because book value itself will grow by 10 to 12% every year. So if the index just stays where it is, by default, by next year, at the same time, the price to book will be 3.7, 3.8. So that's one way for markets to get cheaper with a bit of time consolidation, or there's a correction at some stage. So this is where we are. It's important to just mention where it is so that people understand a bit of the risk reward. There's no doubting the long-term story, and I've shown you that it's a great value that can be created over time through stock selection. But there is a price that we have to obviously keep in mind when we're buying into the market. And just to give you a sense of this overall 4.2 times price to book, where are areas that are above average, below average relative to history, we've just shown various components of the market and how they're trading versus the average of the last 10 years. And you notice the parts that are still very reasonable is largely financial services. So this looks like a very interesting area of the market to be in. Most of the rest of the market is above average. And I would say the large caps are still probably the most reasonable of the lot. So large caps make sense. If you look at mid caps and small caps, they're at a massive premium to their long-term average. So the way we see things, therefore, is for investors at this stage, our view is, one has to be just like, let's say, at the bottom of a market, when the market is at 2 times price to book, actually that's the time to take the highest risk. You'll feel the most amount of fear, but that's the time to take the highest risk. That's the time to actually buy small caps, mid caps, which nobody wants to touch at those points. People that time will want to buy quality, large caps, safe names when the markets are down, actually. But that's the time to take the highest risk. And conversely, when markets are at highs or at very high valuations, that's the time to actually move towards quality and large caps, rather than be very exposed to small and mid caps, which is clearly way beyond fair valuation. So we think if one has to allocate, I think A few things that needs to be kept in mind: prefer large caps over small caps. Financial services as a sector still makes a lot of sense. And I would say maybe a hybrid type approach with a mix of debt and equity. Those type of funds, balance funds, hybrid funds, would be a slightly better place to be, so that you're not necessarily taking excess risk. So these are the sort of mixes that we think will produce a better outcome. And one has to be a bit mindful of some of the near-term valuations. So that's a very broad sort of view. I thought we would just give you the facts. I've got actually one more interesting slide, and maybe I'll just show it to you anyway, which is here. When we look at broader market valuations, we just picked up various points, peaks of previous markets, troughs in the past, bottoms, and various interesting points. And we just wanted to see at those index levels, what were the ROEs, what was the price to book, and more importantly, within the market, how many stocks at a broader level of all the listed stocks, how many were trading below book value, how many were trading above 3 times price to book. So you'll see in Jan 2008, the global financial crisis, that peak before the financial crisis hit us, we were at 6.2 times price to book, very high, but that was because the ROE also was very high, 29%. The higher the ROE, the higher is the price to book as a rule. And interestingly, 6% of the stocks that were listed, of the total listed stocks, were trading below book, and 17% trading above 3 times price to book. By March 2009, when the market bottomed, 32% of the stocks were trading below book, and 4% only were trading above 3 times price to book. Then another really bad phase was September 13, when we were a fragile 5 economy. That time, the price to book, look at the mid-cap price to book, 1.2 times at that point. 55% of stocks were trading below book, 55% of stocks listed, and only 10% were trading above 3 times book. And then after that, we've had obviously a very good period. The last panic was March 2020. In March 2020, again, the market had fallen to almost 2 times price to book. Mid caps were 1.7 times. 45% of the stocks were below book, 9% above 3 times price to book. This has been the bottom of this cycle. And now, as it stands today, we are 4.2 times on the Sensex, 4.5 times on mid cap. This is almost matching Jan 2008. And 13% of stocks are trading below book, and 31% above 3 times book. This is the highest number ever in terms of proportion of stocks trading above 3 times price to book, whereas ROE is broadly in the same range. So this just gives you a feel of the broader market. So it's been a very broad market recovery for the right reasons, because we've had also earnings growth. But clearly the valuations that are now working is factoring in a lot of that good news, and therefore we have to be a little more measured in how we look at future returns and some of the volatility that we may have to deal with. So flows, of course, very strong support, but then we've seen valuations do work. So flows start getting balanced off by supply as well at some stage, and then sort of we go through these phases where valuations need to consolidate. So that's a quick snapshot. I think I'll pause it there and give it back to you, Kamal, for any further questions.
Sure, Anup, I think it was a very insightful and very crisp, 6-slide presentation. We have covered almost everything. I remember, around 2020-21, when you had launched this product Phoenix portfolio, there were certain articles that you had written. You were mentioning that from here onwards, markets will see a diverse participation, and a lot of sectors will participate. Then I would say just before COVID, for last almost 3-4 years, we had seen market be very narrow, and some of the top large cap stocks or quality businesses, or we could say growth style of businesses, were the ones who were participating. And then after COVID, we saw market kind of gave much more returns in the value style, especially after 2022 when interest rates started to go up. Now at this juncture, when obviously we understand markets are high, and valuations are relatively much higher than averages. Where are you thinking? Where are you seeing? Maybe in the next bull run, after markets have corrected,
Yeah.
where will money flow? Because the macro scenario of interest rate now seems to be kind of, uh, it seems to have kind of, made its peak, and from here it will gradually come down. So if you have to kind of comment on the big picture of we like, moving from growth to value, and now are we again going back from value to growth, or within that, what are the kind of, I would say, shifts that you are kind of seeing from here onwards?
Sure. So that's a great question, Kamal, because you're absolutely right. We've seen both extremes in the last 5 years, a growth extreme, and now we're beginning to see a bit of a value extreme. I think value is now well priced. So I don't think there's much value in value, so to speak. And I think as we go through a phase, as I mentioned, when market valuations are generally high, people prefer quality, prefer defenses, prefer large caps, which is where you tend to find higher quality, as it's called. So I think it's moving from deep value or just valuations to quality or defenses. You can call them growth. There's an element of growth in them as well. But I think that's the shift. It's a quality shift that will probably happen or is happening already actually, and will probably continue to happen. So that's where we are seeing more of the focus incrementally. It will be more large cap. It will be more quality. I think financials. We saw the chart. Have underperformed for a long, long time. I think that will be a much safer area. Very unusual because normally the big corrections come with financials as the high beta sector, but this time around it's actually looking more defensive. And I think that's going to be the focus. So the traditional value part of the market, I think, needs to pause. And what has done very well over the last 4 years may not necessarily continue in the same velocity. I think we will see a bit of a shift in the internals of the market, which we've been already witnessing for the last month or two.
Sure, Anup. Recently, I think, the start of this year, you had also mentioned, I remember reading one of the articles, that 2 years from now, maybe by 2026, 20% of AUM will be led by alternatives.
Yeah.
So can you please kind of throw more light on, what do you see as alternatives? Because alternatives is a very broad area, and you as I would say, thought leader for investments, if you could explain, what is your, I would say, definition of alternatives, and what did you mean by saying that?
Sure. So we speak about alternates because in our business in 361, half is listed equities and half is what we call alternates. Alternates are everything that is in the private market. And so that includes private equity, it includes private debt, which we call structured credit. It includes real estate, infrastructure, those type of assets which are in the private domain, unlisted, illiquid. But these are very big areas globally, by the way. Some of the biggest part of alternates is infrastructure and credit. That's where a lot of money sits. India has been a bit of a very different market where today you don't have, those are the smallest parts of the piece in alternates. But alternates are being very sought after globally because it's a place where you can probably get slightly better valuations because of the liquidity. You can get access to certain types of transactions that can be very customized. And you get a very interesting risk reward mix because you have both debt, equity, and you have very low volatility because these are private, right? So they're not trading on a daily basis. And global institutional investors actually love the fact that there's no volatility. They're very happy buying into an asset that is illiquid and then creates value over a period of time with lower volatility. So globally, we're seeing a lot of money flowing towards alternates. And alternates are now close to 20% of global AUM. So global AUM today is about 110, 120 trillion dollars of asset management, all asset management globally, of which close to 20% is alternates. So our view was that India is behind, but India will catch up with that global trend. That's why we say we will also be at 20%. Right now, we are more like 14%. But I think this space will pick up a lot. And today, maybe its pickup is not as strong because public markets are doing really well. So most people are saying, "Yahin pe mil raha hai, to why do I have to bother going into something private?" Public markets are doing really well. But we know public markets also go through cycles. So whenever it goes through a cycle, then alternates start doing much better. So I think we will see a phase where alternates will become more prominent. I think it's important also for an Indian household to look at alternates, particularly let's say structured credit, where you can enhance your rate of return through, let's say, either performing credit or if you're very high risk, even through distressed credit. But they're very interesting instruments. Similarly, real estate, infrastructure can give very interesting yield-based outcomes, uh, which is beyond just the traditional bank deposits or debt mutual funds. So I think it's an interesting space. The barrier to its growth right now is the size that the regulator stipulated that it is only available for a minimum size and above. But as India gets wealthy, more and more people will be able to afford it, perhaps, and therefore, we should see a bit of a pickup there. So we're quite optimistic on where alternatives will be over time.
Sure, we share the same view. That is why we had set this platform PMS AIF World 5 years ago. Moving on to the next question, in your last two slides where you kind of have given some kind of an alarming signs on valuations being quite high and similar or maybe higher than the levels that we saw before 2008-9 correction happened. Now, obviously, we remember that that correction which happened after subprime crisis in 2008 was a correction which was a 60% plus correction for indices. At this juncture, when again in terms of price to book and the numbers that you showed, when we know that valuations are even higher than those numbers that we saw in 2008, are or does 361 make any projections on what kind of correction will we see from here onwards? How deep will be corrections?
Yeah.
Because we are managing public money, I'm sure you would have uh, some mechanism or some kind of investment committee meeting, like I know every one day in a week all of
Yeah.
you meet, right? So I'm sure this is what you must be discussing, how to contain this time, because many investors who have given money to you, they would have, I'm sure, this question on their mind. We are all long-term investors, but the past experiences this time, are you going to kind of handle it differently, and are you planning for that, and how are you planning for that?
Sure. So first of all, Kamal, I don't mean to be alarmist. I'm just stating the facts. I think it's very important. My job is to put the facts in the right context and not sugarcoat it. Very optimistic, but also, a bit wary, obviously, of the price that we're paying. So it's important to just put it in the context. As I mentioned, I think my bent of mind is we would probably see more of a consolidation than a drastic correction. Normally, the big corrections in India, those 30% falls, have happened also around events that have largely influenced our financial services sector. So, global financial crisis was the last obvious one. So even in 2013, we had, when India was a fragile five, it was financials that took the bulk of the beating. So typically, we've had problems around financial services, typically. Right now, as we all know, bank balance sheets are much better than they used to be. And barring maybe some small red flags in consumer-related credit in unsecured consumer loans, by and large, it seems like they're in a good shape. So I don't see it being driven by banks clearly, and the regulator has been very tight in terms of managing it. Indian regulation has been probably one of the most stringent and most proactive globally. So I think we're not really expecting a deep correction, definitely not based on what we see today as India's fundamentals. If something global were to occur beyond our control, sure, it can happen everywhere. But I think from our standpoint, we don't really, we'd see a time correction. We're saying the market needs to consolidate, needs to spend time and get cheaper by time. as book value continues to grow. So we're not looking at very massive corrections. See, 10-15% corrections are par for the course. I mean, that's the nature. That's supposed to be what equity should do from time to time. We've not seen it for a long time, so we're getting a little spoiled. But that's a very natural thing to happen. But like you correctly mentioned right at the start, it's the flow factor that is removing volatility, it is removing deep corrections, it is creating the sense that equities have largely one way to go. But just having spent 30 years doing this, you know that it can stretch, but some point reality comes into play, and flows can only take you up to a point. So I do feel, therefore, that maybe our current thesis is that this will probably be either shallow corrections or time correction. Nothing dramatic that we can see right away. But again, as I said, a hybrid type approach is probably better.
Sure. Apart from India, what are the other economies from the point of view of investing in equities that you see or you yourself are kind of allocating your money, or you recommend or suggest to be considered by some of the HNI investors at this juncture, given valuations or given upcoming potential and possibility?
Yeah. See, for all I've said, almost all my money is sitting in India only, as in even personally. We hardly invest overseas, but I'd say when we just look at the landscape globally, clearly within even the US, barring those top 7-8 names, I think there's a lot of value, frankly, as you go down the spectrum. I mean, just to give you an example, something like Pfizer in the US trades at 1.6 times or 1.7 times price to book, versus Pfizer here, which trades at 8 times price to book. It has a higher dividend yield there than it has over here. Valuations are much cheaper there than here. The parent company of Pfizer India. So, the valuation distortion is pretty significant. I've just given you one example, but there are many such examples, which is another reason why a lot of multinationals are looking to list now in India. That's why Hyundai is looking to list, LG Electronics is looking to list, others are looking to sell some of their holdings. So there's a fairly interesting spectrum of valuations that exist world over. I think there are pockets of value clearly in the US, and I would say that's the principal market to look at. It's very, very difficult to look at markets beyond that because most of them have structural problems. China nobody understands. Maybe it will turn at some stage, but that's got to be a top-down call. Europe has its own issues. So I would say, US and India, we normally tell people what US is as for developed markets, India is for developing markets. US dominates the West in a way, India dominates the East from a market investing standpoint. It's very unique, it's very different from most of the markets here. And it has the same broad principles, entrepreneurship, capital allocation, scale, maybe in different types of businesses. That's more tech driven, we are more traditional, but the principles are broadly the same. And therefore, India and the US continue to be the number one or number two markets through any time frame that you pick up. The last 5 years, 10 years, 15 years, 20 years, number one, number two is India, US. So I think we see it as India and maybe some parts of the US, other places to be essentially in the portfolio.
You also mentioned, and we all know that yes, in India, 1/3 of market is dominated by financials. Let's delve more, on financials as a segment. Where are you more, I would say, seeing valuation comfort, or you're more bullish within financials? If you have to kind of, because financials today is like
Yeah,
very broad, and there are
sure.
many new age businesses also which are there in financials, which we call as say fintechs, and many old businesses are also trying to delve into fintechs.
Sure. No, I think traditional banks we like. I think that continues to be the dominant part of financials in India and also cheap. So traditional banks, we like insurance as a sector. I think that's also a sector that has consolidated for a long time. It's doing better more recently, but we think valuations are still very good in insurance companies. And then within NBFCs, of course, it's a selection. Some of the small finance banks are interesting. Capital markets has been the roaring part of financial services. That's done really well because capital markets have also done well. That's the place where there will be probably higher beta depending on where markets are. But I would say traditional banks, parts of NBFCs, insurance, these are the parts that I think look like relatively safer. Some of the capital market plays might also be interesting, but that one will have to probably tolerate some more volatility there.
So moving on to the second sector, as per weights, which is IT in Indian context. We have seen, that sector has also consolidated for last quite some time, especially the large cap ones. How are you seeing that sector now from here onwards?
So IT also, Kamal, is higher valuation than the past. Part of it can be justified by the fact that the capital allocation itself has changed. They used to sit on very high cash in their books, which they've given out. So their ROE profile has improved. Therefore, valuations deserve to be a little higher. But growth is more modest. So the way we look at IT is that we've gone through a lot of cycles already in the last 3 to 4 years in IT. We had a boom, then a bust in IT just in the last 4 years, and now it's consolidated for the last year, like you mentioned, and things are getting slightly better on the margin. But we're talking about marginal improvements in growth, nothing dramatic. So there's some parts of IT that are continuing to grow, the mid-cap, right? Some of the mid-cap names. The larger cap names have been struggling in terms of their overall rate of growth. But our sense is IT does tend to be a bit defensive. So therefore, in a situation where the market consolidates or corrects, IT will tend to outperform just by not falling. But are there big upsides in IT from current valuation standpoints? We'd say it's more like in line with what you would expect, 10 to 15% potential. Nothing dramatic. We don't see some big re-ratings as far as IT is concerned, especially amongst the large caps.
Sure. Moving to the last question. You have been a fund manager, starting with mutual funds, and now you are kind of managing as a CIO and head of equities for both alternatives and mutual funds. So over this journey, you have seen, in the initial part, mutual funds were like kind of dominating. Now gradually, alternates are also been making their mark, and we discussed that part already. At this juncture, when we know there are many new investors, especially in the retail side of market, that have come up to the mutual fund side, and today mutual fund AUMs have grown, I think, 10 times in last 7-8 years, and that is where SEBI had done stress test. I do not know, how to comprehend that stress test, and where do you see, like, I'm talking particularly about the small and mid cap side of mutual funds, because when we're talking about markets and way forward, and we're talking about valuations, and we are saying that let's talk our heart out and let's not be diplomatic and let's state facts. From that point of view, because there are so many investors who are still adding more and more money by way of SIPs in small and mid cap mutual funds. How do you see, any risk emerging there, and what are the things that investors should be cognizant about, given the fact that the AUMs have grown a lot?
No, I think that is itself a risk. The very fact that small mid-cap funds have the highest number of folios now in the system, which means effectively it's chasing momentum. That's what is happening. And chasing momentum is not a strategy. I mean, it's a strategy that ends very badly once the momentum changes. So it is worrisome to us, the number of folios going into small mid-cap funds. And this is very one-sided flow because there's illiquidity. As money comes in, you're just pushing up prices way beyond fair value. And you can run with that sort of phenomena for a year or two, but fundamentals do catch up. And so far, I would say till last year, you still also had earnings support at some level because earnings of small mid caps had actually grown the fastest. But incrementally, that's not going to be the case throughout. So I think now as small mid caps also end up growing more in line with averages, I think some of the extra valuation will have to correct itself. And for small mid-cap funds, it's going to be a big challenge because the liquidity in the market is totally not commensurate with the sizes of these funds. I think that's one of the biggest challenges the regulator will have to deal with, because you can't stop people from investing. But whenever a problem like this occurs, I guess that's why they're trying these stress tests as well. But it's at the end of the day, the proof of the pudding will come only when you actually have to sell. And when it's okay to calculate the liquidity, hypothetical liquidity of your portfolio, but reality is when you actually have to liquidate, and that time everybody will want to cut, typically, and that makes it even more illiquid or more impactful. So I think, we are a bit concerned that maybe this whole category has grown way in excess of what it should have, and is in a bit of a bubble territory. So that is something to be worried about, which is why, again, we're repeating that large caps seem to be in a much better place to position oneself if one has to look at equities. Stay with quality and large caps, and incrementally be very careful as far as small and mid caps are concerned overall.
I'll just take one more question, given the kind of questions that are coming on chat. We've also seen emergence of quant-based funds, over last, especially 3 years, and last 2 years, quant funds have done really well. Even 361 quant fund has done phenomenally well, even better than some of the other fund manager-based funds. You have kind of grown over the last 2.5 decades, seeing the entire process of fund management where there are sector specialists, maybe economists, but now is the time where some of quant-based funds have also come up. How do you see this shift, and how you, as a, I would say, almost 3-decade-old fund manager, are adapting yourself as a thought leader in this space to quant-based funds? Are you able to accept that with a lot of conviction, or you're also kind of accepting that with reluctance and kind of see that as a trend coming up?
Yeah, no, so there's no reluctance. I mean, at the end of the day, all of these coexist, fundamental investing, quant-based investing, passive investing, contrarian investing, all of that is part of the market. I don't, they have their own ebbs and flows from time to time. Quant has come up a lot also because this has been that type of market where momentum investing has worked, because it's been pretty much unidirectional. And most quant is, at least most of the quant funds today, are using the momentum factor as one of the key variables. You have different factors in quant as well. You have quality, size, volatility, you have momentum, you have value. Now, it's been very strong on momentum. Therefore, all quant funds which are momentum driven have also done very well. We keep highlighting also the fact that that in momentum type quant funds, whenever the momentum of the market shifts, there will be a period where such funds will tend to underperform because you're sitting in the wrong momentum. But then in 6 months' time, they readjust to the new momentum. As long as momentum has a consistency, these funds can do very well. If the market is going nowhere, then these funds will tend to struggle, because if momentum starts dying out, then there are fewer things for alpha creation as far as a quant fund is concerned. But as I said, quant funds is just a broader name for an umbrella of a lot of strategies. Momentum is one of them, but there are others that we will also do, and others will do, I'm sure. Other factors that will keep coming up in the market. The market also rotates around factors. Today, momentum is doing very well. Tomorrow, some other factor might be doing well. Size might do well, or whatever. So I think they've clearly done well, but that's in the past. There is a value to having quant funds. It's a very simple thing. Factor investing, as I said, plays a role. It works. Different factors work in different markets. If you can identify the right factor, you can do very well in a quant fund as well. So I think they'll all coexist. I don't see any one coming at the cost of another. They're all very interesting strategies, and so is ours.
Sure, Anup. I think it has been really pleasure conversing with you. Second time on our platform, and as always, it's pleasure as well as insightful, and a lot of interesting things have been discussed. Thank you for your time, and thank you for joining us today on this Friday evening.
Thank you, Kamal. Thank you, and thank you to all the viewers for spending your time today, and have a